This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 25th, 2016, featuring Update Analytics, primarily incorporating data from the Update Energy Feed, Baker Hughes, and CME Group NYMEX. We'll break the report down according to the 5 regions covered by EIA, beginning left to right with Pacific, Mountain, Midwest, East, South Central, and then we'll cover the overall lower 48 United States. Highlights from this week's report: there's 117 BCF drawdown. Pacific region actually experienced a small injection. 3 of the 5 regions are experiencing a record surplus along with the lower 48, and the all-time record low U.S. rig count continues. Let's go to the charts. Beginning with the Pacific region, all the charts are constructed the same. The heavy blue line is the gas and storage. The black dashed line in the top pane is the 5-year average of storage. The light green dashed line in the top pane is the 5-year average maximum, and the light red dashed line is the 5-year average minimum. Moving to the center pane is the amount of either injection in green or withdrawal in red, and then we take the difference between the gas and storage and the 5-year average, and we determine whether we have a surplus or a deficit. So going over Pacific region, we've got 256 BCF in storage in between the 5-year average and the 5-year average maximum. As we touched on at the start of the report, in the center pane, you can see there was a 1 BCF injection, and the surplus is up to 36 BCF in the Pacific region this week. In addition to the gas storage, we'll go over the basis differentials. This is the Platts versus Henry Hub basis differentials. On the left is PG&E for the Pacific region. You can see that basis differential expanded to a slightly larger premium than last week. And then on the right side is SoCal basis. It's trading at a discount, but slightly less of a discount than we experienced last week. Over to the Mountain region, 147 BCF in storage right up against the 5-year average maximum. There was no gas either injected or withdrawn from the Mountain region this week, and the surplus there has expanded to 14 BCF after being fairly stable the first 2 months. Basis differentials for the 2 delivery points in the Rockies, or in the Rocky and the Mountain region, have both trading at deep discounts. The Midwest region is just slightly above its 5-year average maximum at 645 BCF, and that's following a 44 BCF drawdown. The 161 BCF surplus in Midwest is a new record for this reporting format from EIA. Only one delivery point that we cover now in the Midwest, and that's the Midcon basis, or Michcon basis. It's at 7 cents, and you can see that all this year that it's been cut in half from roughly 15 cents. East actually had a large drawdown of 56 BCF down to 500 BCF, roughly halfway between the 5-year average maximum and the 5-year average. This is one of the regions where the surplus has actually collapsed some this week down to 78 BCF. 3 delivery points that we look at over in the East. 2 of them are trading at a deep discount and have been all year. And the one that is trading at a premium, you can see that we started the year at $2.50, is now down to has reduced by more than 90%, down to less than a dime. South Central region, this is most close to what we used to discuss as the producing region. This includes Texas and Oklahoma. Still more than 1 trillion cubic feet of gas in storage in the South Central region. We only drew down 18 BCF. It has been very seasonal. Nice temperatures here in Dallas. So that 1 trillion cubic feet, well above the 5-year average maximum. And you can see that the surplus down in the bottom pane at 287 BCF. So at roughly a 20% surplus in the South Central region. Not surprising, all 4 delivery points that we look at in the South Central region are trading at deep discounts with that excess supply. Lower 48 United States, you can see in the middle pane the 117 BCF drawdown that we discussed at the top of the report. 2.6 trillion cubic feet of gas and storage right at the 5-year average maximum, and over 0.5 trillion cubic feet of surplus. This is the total rig count for North America, so this includes rigs exploring for oil as well as natural gas, down to 487 after last Friday's Baker Hughes report. The brown dash line I've taken across there horizontally, and we go all the way back to July of 1999 to see similar activity levels, and this looks to only go lower. It is possible we could take out the 392 rigs that we saw back at the start of 1999. This is the U.S. rig count of rotary rigs focused strictly on natural gas, United States only. 242 was the low mark we set back in 1992. We're now down to 101 rigs. So every time we stack out another rig that was previously drilling for natural gas, this is a new all-time low for natural gas. Unfortunately, the reduced exploration and production activity is not helping us from a pricing standpoint, neither is the seasonality. The top pane are the NYMEX Henry Hub natural gas futures, the data coming to you from eSignal. They're continuous contracts, so this is not roll adjusted. Discuss that a little bit more in a minute. In the bottom pane, we have the 10-year weighted average of annual seasonality. Natural gas has some very pronounced seasonality. Currently, starting at the first of the year, and actually it extends out of the winter time from the previous year, we have a lot of volatility, but it's roughly in a seasonal weakness. As the injection or drawdown season ends, typically in March, we will see some stability, and then during the spring and into summer, we get some seasonal strength there in green, but you can still see we have several weeks before we get to the time of the year where we could expect any kind of seasonal strength in natural gas. So in the short run, we still expect seasonal weakness. This is the daily cloud chart. Again, this is the same data that we looked at before, eSignal's continuous chart. The reason that I bring that up and make the distinction between whether this is eSignal or comes from the update energy feed is whether it's been roll adjusted or not. This data is not roll adjusted, so looking at the chart, you can see here that natural gas made a low back on December 18th, down here around $1.75, $1.76. What's important to realize about that is the contract that made that low toward the end of December was actually the February contract. The January contract had already gone into delivery at that point. So this is actually February natural gas traded down that low, and the low that we're making today is actually is April natural gas. So these are not exactly truly fungible. Even though they're fungible for quantity and quality, they're not fungible based on the time of year, and as we know from the seasonal trends in natural gas, that can have a very pronounced effect. In any case, the things that we want to look at on this daily trend chart, everything is negative. The price and the blue lagging line are both well below the cloud spans. The cloud span is negative. You can see that by virtue of it being colored pink there to the right edge of the chart. The green turning line below the purple standard line, and the price working below those. So every possible parameter that we look at on one of these charts is negative and bearish. Shift T and update analytics will bring up a three box reversal point and figure chart. I've set mine for 1%. It's a logarithmic chart so that it's somewhat agnostic to price level. And it'll also bring up automatic counts. Same as what we just saw in that daily cloud chart, well below the bearish resistance line, several intermediate downtrend lines. Previously, we had all of these targets that were realized and one active downside target to $1.57 with no active upside target. So same as what we saw with the daily cloud chart. This just confirms what we were previously seeing, a very bearish picture on a daily time frame for natural gas. So looking out several months, we can anticipate through the end of drawdown season more weakness. The 60-minute point and figure chart, this changes our time frame a little bit. Again, a three-box reversal chart, somewhat similar to what we saw on the daily chart. Well below bearish resistance, several intermediate downtrend lines, no active upside targets, and now we have two active downside targets, one to $1.61 and one all the way down to $1.44, 15% below where we are now. The actual futures, this is NGJ6, so this is April natural gas futures. This is what we discussed on the daily chart. This is what that daily chart is being constructed from. And trading up or trading at $1.77, that's down over 3%. When the report printed this morning, we were already somewhat in this downtrend in this column of O's. It sold off more and bounced slightly. The forward curve for natural gas is painting a pretty bearish picture as well. If you look at this chart, you can see toward the end of every year where we get that seasonal strength from, and you can see that we get there in the fall when injection season or drawdown season starts. There's some uncertainty and gas gets bid up, and then it sells off there shortly after the first of the year, and then we get some of this summer strength as well. You can see that for 2016, all of that strength has been sold out of the market with the excess supply. If we go back and look at 5 days ago, we've really shifted down sharply here at the near end of the curve, not so much out at the far end of the curve. And if we go back and look a month later at the blue dash line, we're down pretty well at all deliveries. So there's no anticipation in the market right now of any kind of constrained supply or excess demand. One note on demand, Cheniere did ship their first LNG shipment from the Gulf Coast terminal this week, and still we've seen no strength at all for prices. One thing I would like to go back to on this lower 48 chart before we leave today, something that's important is we go back and look at typically this is when drawdown season ends. It'll be in about 4 weeks, 6 weeks at most, and we'll begin injecting gas. If we go back to April of 2015, we were down here at about 1.5 trillion cubic feet when we started the injection. We're still at 2.6 trillion cubic feet right now, and so it's hard to imagine that we're going to draw down 1 trillion cubic feet of gas in the next 4 to 6 weeks. That would be up there near 200 BCF withdrawals, and as you can see that this year we've only had that happen one time, and it's hard to imagine given the unseasonably warm weather that that's going to take place. So what I expect we're going to see is that we'll begin injecting gas at much higher levels, so there's not much reason that we should see very much effect from that seasonal strength, given that we're going to be well supplied with gas. This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 25th, 2016. If you have questions or comments, please feel free to email me directly. If you'd like to learn more about Update Analytics or the Update Energy feed, please reach out to their sales team. Thank you and have a good weekend.